This episode of LBM Talks Credit is sponsored by PWT. And at PWT, you get more than an engineered wood supplier. You get a true partner who's ready to support your success coast to coast. And that's something they're willing to shake on. Hey there, I'm Thea Dudley, also known as the Credit Overlord, and welcome to LBM Talks Credit. We are the only podcast that talks trade credit in the lumber and building material space. Never miss an episode, stay tuned, and we're glad you're here. Well, my friends, welcome back to another episode of LBM Talks Credit with Thea Dudley. We are going to break down one of the least talked about areas of the credit process. And first, I'm just going to go on record as saying, I hate this topic, mostly because it's hard to understand and I've been burnt to a crisp by it. I've got a couple guests with me today, and we're going to talk about one of my least favorite topics because I'm still a little scarred and bitter. So I have Bobby Williams with Coface Business Services and Joe Ketzner with Coface Trade Credit Insurance. Credit insurance is our topic of the day. And for those of you that have not had the pleasure of talking about credit insurance, you're in for a treat. Welcome, guys.
Thanks for having us.
Thank you, Thea. Appreciate it.
And Bobby, I think I got your title wrong. Business credit information, not services.
That's okay.
Listen, I struggle with titles. It's like you work there and you do something. We're good.
You got the name of our company right. That's a plus. That's right.
Okay. Well, my experience with trade credit insurance, the first one was when we were selling internationally. And I think the biggest challenge is usually the person signing the contract and doing the negotiations is usually, a lot of times your CFO, which in our case it was. And they don't share with the credit team what all is in there. It's just, we got credit insurance. We're so golden. So we're shipping, thinking life is great. And then you find out something goes wrong. And it's like, okay, Joe, I'm going to make this claim. And it's, let's say, 100,000. And you're like, well, there are some steps you have to go through. And that's when, I flipped my hair and lost it. And a lot of bad words came out of my mouth. And everybody in the company, I'm sure, heard it. It was, I was just so ticked because I didn't know any of this. And unfortunately, I took it out on our poor rep. So thank God it wasn't you. But it was very frustrating. And I think that's one of the things that credit insurance can be a great tool, but it's often misunderstood. And those of us who have had experiences with it, they're not always great.
And that's fair. I mean, it's a very fair comment, especially when you look at how trade credit insurance is presented to the market. So a lot of times when we're going in to talk with a business, we're talking with the C-suite to look at this as a financial tool. And it's overlooked going further down into the bowels of the business of how this is actually going to be utilized. Because I could tell all of my team, we're walking into a business to tell them the way that they're doing business isn't right. And we might have a solution and it's going to cost them money that nobody budgeted for. So it becomes a dance between the C-suite making the financial decision and the credit teams that are actually going to be utilizing it. I've always been a big proponent of making sure that the whole team is on there. You can talk to the person that it's going to be writing the check for the product, but if the team that's actually going to be implementing the trade credit insurance isn't on board and understands, they're not going to be a client for more than a year. They're out the next year. So I feel what you're saying, and I've run into it, and it's something that we're trying over and over to overcome because it is a huge roadblock for the success of the product.
Well, and once you go through it once, you know the questions to ask. But, I do think it's one of the most misunderstood tools. And I got a little bit further involved with it with one of the companies I worked for. Every time we would acquire somebody, especially in the upper Northeast, it was, Thea, don't worry about it. We have credit insurance, so we can sell whatever we want. I'm like, that's not what that means. So I need you to calm down. There are rules. it's a little bit like outsourcing your credit department, but not. And one of the things I do like about it is you can actually kind of cap what your bad debt's going to be for the year. Like, here's what my policy costs, and then kind of back into it from there. So I'm gonna hit you guys with some questions, because it's just such a gray area of the business. And I know there's a lot of credit people out there that really don't understand it, because I didn't. And I'm sure there's still a lot of it I don't understand, because my experience has been, no, you can't do that. What do you mean I have to pay money? What do you mean I have to jump through these hoops? It was all like a surprise. It was like a gift that kept giving, but I didn't want the gift. I couldn't give it back. So one of the things I want to ask you is, it's, how does it work? I know it's like a prenup, but how exactly, if you had to explain it, just like elevator speech it to me, how does it really work?
So I think the best way to look at it in that standpoint is breaking it down to the simplest form is it's going to be a relationship of information between the insurance side and your business. Any decisions that are made from the insurance company comes back to you as a business decision. So the easiest way is you ask for coverage. I say yes. That's easy enough, right? Now you have to make a business decision, because I look at risk differently than our customers look at risk. So I could say somebody's good for $1 million. Does that mean you want to sell them $1 million? What does that mean to the rest of your customer base? What does that mean to your product? Do you only have a certain amount of product to sell? So just us saying yes, or in the other regards, if we say no, you come and ask me for coverage, and I'm saying I'm not insuring this account, and I'm giving you reasons why it is a high-risk customer on our side, you could decide I'm going to do business with them anyway because my margins are X. I get 2 shipments out of this. I've already covered any loss that I'm going to have in the future, and it's just gravy for us. So understanding that the partnership is truly a partnership in that we're looking at risk a little bit differently than our customers are, but understanding, to your point, the gray area of where that means from a credit management standpoint of knowing when to say yes and when to say no after our decisions.
So I call you up as a credit manager and I say, look, we are looking at credit insurance for our receivables. Where do we start? Do I insure the whole thing? Is every account covered? Can I pick and choose? What does that look like?
For better or for worse, there is a billion different options that you can have with it. And that becomes a little bit of the problem. And it becomes when you want to make sure you're dealing with someone that understands the product, understands the business, and also understands your business. They don't have to be an expert per se, but they have to understand some nuances. Is there seasonality? Is there international, like with the one company you were speaking about? Understanding that can help frame it. But everything that you just said, do I have to insure everything? Can I be selective in who I'm insuring? We can segment policies to fit the needs of people. What we can't do is we can't take a hot potato. You can't say, this is the one that's about to explode in the next 3 months. Do you want to insure it?
Yeah, can you take my junk accounts, because we don't want to take the risk, but we're going to ask you to insure them. So I understand that you're like, look, don't send me your dogs. I don't want them. You don't want them. I don't want them. I'm not going to be able to qualify them. But some of the experience in looking at a whole AR, where they're like, look, we have our whole AR covered. The process for them was so different, where, the whole, I'm just going to sell them whatever I want because we have insurance. And so it'll cover it. It's like, no, this customer is approved. This customer is not. You sold him at your own risk. This customer is only approved at 50,000. Why is he at 150,000? What were you thinking? They're not going to cover that. So those are the kind of things that I think those nuances escape people, because all they hear is, we have insurance. It's just like, well, we have lien rights. It's like, that doesn't mean it's bonanza, go nuts.
Exactly. And it gets back into the communication, both from the C-suite as well as from the credit team, is what are the goals? What are you trying to achieve in trade credit insurance? There's really 4 cornerstones of trade credit insurance and why people buy. They're looking for a sales expansion tool, which can mean a number of things to every business. It could be a brand new customer they've never dealt with before. So now they're able to look at us to help evaluate that risk and provide coverage. It could be an organic growth to what you said before. You might have been selling them $50,000, but if you had $100,000 in coverage, you could sell them $100,000. Looking at that sort of growth, or going international, a brand new region or a brand new product. We see it a lot. I believe you mentioned earlier with acquisitions. These are companies you don't know. If you're able to wrap that with an insurance product, that is a sales expansion tool that we're able to do. The other three are looking at it straight from a loss ratio standpoint. We call it sleep insurance. There's a line that every business has that says, I can take a loss of, we'll say $10,000. It doesn't ruin the day. It's business. It happens. I'm not worried about it. And I always talk to the credit team and I say, when does that move up? At what point do you have to go into the CFO's office? At what point does the CFO have to go to the CEO's office? And how many accounts are above that line? What's that line that you have in the sand? And then you can start to talk about it from the loss perspective of, this is a meaningful loss issue, and credit changes daily. So what might be good today won't be good tomorrow. So by having this and putting a flat line across it really helps credit management, sales, and the C-suite look at this as being a win for them. The third is looking for bank financing. If a company is pledging their receivables to an asset-based line of credit, we just wrap those receivables with credit insurance. That just guaranteed your collateral to the bank. And you should be able to get a higher advance rate for working capital if that's needed. That might not be something that's on the credit team's radar, but that's something that's on the C-suite's radar if that makes a benefit for them. And the last one, which they all roll into, is just credit management enhancement. Thea, you've been doing this for a long time. Information is king. How much information can you have to make a decision? How new is that information? And what if the information isn't correct? What happens? So by pulling the insurance in...
Bad things happen. That's what happens.
Exactly. By pulling the insurance in, it helps to supercharge the credit team, because now you do have that ability saying, my gut is telling me here, insurance is telling me here, where can I be in between that makes sense? Because I'll say it to everybody, credit is impossible. You're either on too long or you're not on enough. You're never right. So you're always in a balancing act to try to do it. And credit insurance helps to even out the seesaw effect of that.
I like to equate it to standing up in a hammock. You're always moving your feet to try to figure stuff out. Now, I think you've done a really good job at helping to demystify this. So I want to keep breaking that down a little more. So let's say I've worked with my CFO as the leader of my credit team. Maybe I'm a team of one, but this is what we've decided to do. Then I have my let's say I have all my receivables insured. And we're working together as a, little bit of an outsourced credit department, little bit insourced. I have an account go. We're going to call it going rogue, not paying. What happens now? I come to you and I say, Joe, I need to make this guy's, he's gone. He's a deadbeat. I can't find him. I'd like to file this claim now. So give me my money. And you say,
I say, let me see. There's three things that we're needing on the front side. Well, there's four that we're needing at Coface, and the fourth is pretty easy to do. Well, actually, all of them are easy to do. I need invoice, purchase order, proof of delivery, with the fourth being a summary aging of what that account is. Okay. Once you file that with us, there's two forms of coverage. There's protracted default, which is what you're asking now. The guy just disappeared. You don't know if he's solvent or not, but he's not paying you and you're done waiting. So if you're done waiting, you pull the trigger, you file it with us. As that happens, our team, once the event is solidified, begins to work at it from a collection agency standpoint. For 60 days, we're trying to collect it, phone calls, Instagrams, skip tracing, looking for them. If we don't find the individual to collect your money from as a collection agency, I cut you a check minus any risk share that's associated with the policy.
Okay.
Then I continue to try to collect it, but now our relationship within that loss change. Before it was 100% on you. Now it's a 90-10 based off of our risk share back on me. So this is now my money I'm trying to collect. So I'm going to go and continue to try to work it. Could be 6 months, could be a year, could never happen. But either way, you got your money on the 61st day. It's a little bit more clean cut on a bankruptcy. They file for bankruptcy, Schedule F, hand it over to us, we pay you in 30 days.
I like that, especially with the increased bankruptcy. So I want to back up for a minute. So the experience I had was, you didn't know. Yeah, what I didn't know was what killed me. And I think that was, being able to pull the mystery back on that. It's like, look, everybody's in business. Nothing's free. There's always a cost to something. So it's like, look, it's just like the insurance on your car. We're going to insure this, but there's a deductible on your policy. I didn't know that. So that right away, that was an opportunity for me to rant. Then there was, hey, you have to wait until we try to collect it for 60 days. I'm like, well, I didn't know that. So there was another rant. And then when it finally paid out, well, now I have this bad taste in my mouth because I didn't know those. I didn't understand those two pieces, which was bad on our company, shame on us. That was definitely not on the insurance company. But I think having your credit, whoever's doing your credit, leading that team involved in those conversations when you first start walking through, hey, this is what we're going to do. We're going to go the insurance route. Let's make sure we understand the process going in and when we have to collect. Because had I known that, I wouldn't have lost it all over some poor guy that's probably still putting Band-Aids on his butt today.
Yeah, 100%. It is absolutely a partnership. And it's something that I like to talk to a lot when I'm dealing with the credit side is, what do you do today? What's this process look like? If someone defaults on you today, at what point are you pulling certain triggers? When are you taking it out of internal collections and sending it to third party? Because if I understand that and you understand what my requirements are within the policy, if they match up, we're good to go. If they don't match up is when you have a situation like you said, which is, hey, I did A, B, C, and now you're coming in with 1, 2, 3. Like, why? Where'd D go? And understanding what the actual process is. So 100% that this is a living, breathing product that requires partnerships between both sides.
Well, so what are the biggest mistakes that you see when credit managers make, and I've already stepped into a couple of them. It's like, no problem sharing where I stepped in a pile of something. What are the common things you see that turn people off from using credit insurance, or where they mess up and then they're upset with you? And it's really maybe something they could have avoided. Like, I don't know, your CFO communicating better with you.
Yes, there's two questions in what you just said. The first one is in terms of what can trip up a client for a claim standpoint. And there's really only two things that are big trip ups. The first one is having coverage on the wrong entity. So you're invoicing one person, but you have coverage on a different person. Just because the names are the same doesn't mean it's the same entity. So if you don't have coverage on the right person, that's going to be very problematic when you're trying to get indemnified. The second is holding on to the debt too long, because as I said, there's a filing period within everyone's policy where basically we're saying from invoice date, you have 6 months to work it yourself. It's a pretty fair amount of time to try to work something. And if you're having success, most every carrier is going to allow you to continue to try to collect on that and give you an extension to it. But it is very important to say, here's my triggers of when something gets past due. When do I have to make sure that I'm informing the insurance company of a collection claim event? So those are the two big ones that we see people get tripped up on, and the ones that we continue to try to reiterate with them.
Well, those are the same ones that are just kind of credit 101 things. It's like, don't hang on to this debt too long because there's no money in it if you do. So I like that. There's some consistency there. Let's take a look at how AI is going to impact or has impacted credit insurance. I mean, Joe, Bobby, maybe one of you, both of you, take it and run.
Go ahead, Joe. If you want to start with the trade credit insurance, I can talk a little bit about the business information side of it.
I mean, we've seen, like every industry, we've seen leaps and bounds from using AI and using simple APIs integration within companies, commercial or credit, as well as their sales businesses, to help utilize tech to make credit better. Where it's going to be in 6 months is as much of a mystery as where it was going to be 6 months ago. So from looking at it from a big picture standpoint, using blockchain, using AI information, using algorithms that is pulling data, at the end of the day, the insurance is just like the information that Bobby and his team are putting out there. We're only as good as the information we get. So the more that we have people that are embracing utilizing the technology, the better it gets across the board. So is there anything specific on the horizon? I'd say everything. We've looked at stuff from individualized invoice coverage, the same way when you're buying a trip, you go on, Southwest Airlines, and you want to insure your trip for $30. We've been looking, the industry's been looking at doing similar things from an invoice to invoice standpoint.
Okay, that is just why. That's actually kind of crazy, because now I would send my sketchy folks over there and be like, I'm going to insure, I will pay the $20 or $30 to ensure that this idiot figures out how to write a check.
Yep. So that's, and to what you said, is the bigger problem, is because then it becomes an information gap to try to figure out how we can make that economically work for the clients as well as for the insured. But all of that stuff is being looked on, and it'll be interesting over the next, I'd say 5 years is going to be the big jump for AI and trade credit insurance.
Well, so Bobby, I want to ask you this, as we're talking about business information. If I'm sitting down and saying, hey, I want to get credit insurance for my receivables, how does the business credit piece flow into that? Or does it, here, I'm sending my applications over there to get approved first, and how does that piece work?
Yeah, no, that's a great question, actually. Yeah, you can't have insurance without the right underwriting, and you can't have the right underwriting for insurance without great credit information, right? So the way it works is, not everybody that you want insured is going to get insured. And it's just a fact.
Look, you take you take my good people, and you take these losers over here too.
That's right.
That's my Christmas wish list. You're probably like, no, nobody wants that. You keep, no.
Yeah. So, and I guess in some respect we would, but it gets priced accordingly, right? So that's kind of how that works. But the information is absolutely critical. And to your question, business information, I would say, I think of AI as kind of like this beast that is just data hungry. I think we're just seeing the beginning of it, right? Sure. There's going to be some challenges with it, because inherently AI is not transparent. It's not like calling up a credit reference on an application. When you're using AI to drive your credit information, you're not really necessarily totally understanding where that information is sourced from. So you could run into, I see some challenges right down the road, some challenges with that, the ethical sourcing of data. And maybe because of that, especially because we're also an insurance company, primarily an insurance company, the regulatory implications of that, right? The use of AI for underwriting is going to be very interesting moving forward. I don't think we've seen the end of it. That issue with transparency is going to be continue to be an issue, I believe.
How does the fraud protection come into all of this? Because that's the other really big topic right now in credit, is anything tech and fraud. And everybody's talking about tariffs, but I almost have to wonder, is it just something everybody's using where it's like, oh, tariffs? Because I have to tell you, I went into Total Wine, and every imported wine just went up in price. I'm like, I know you guys have had this in the back for a while. So this just didn't roll up on the boat yesterday. So is that, I kind of feel like that's almost getting used a little bit, but what does it look like on the fraud horizon within that that platform.
Joe, you want to take that as far
Yeah,
as
from an insurance standpoint, when we're looking at it from a fraud, we've definitely seen an increase. And because of that, we've increased our KYC process for both our clients.
What's a KYC?
Know your customer.
Okay.
So
just don't get all fancy with us using acronyms and leave us hanging.
A whole bunch of them. Yeah, I could throw out a whole bunch of them that are tons of fun. But understanding who the customer is, our customer, as well as who their customers are, because it's rare that you're going to see a new entity pop up with no history that's looking for very specific things. We see it, we flag it, because a lot of times what we'll see is company A is trying to get coverage on company B, but there's ownership that's similar, but it's kind of hidden. And you're like, I'm pretty sure you're going to file a claim on yourself here in about 10 minutes. So we got to dig in deeper. And that's stuff that was missed in the past because of the information gaps and the Know Your Customer initiatives that have been put out. So all the major insurers are doing more and more. And we're seeing it just in the U.S. for used to be able to get a checking account just online. Now you have to go into a bank and you have to show them your ID. It's the same process. We're just looking at that on the insurance side for trade credit insurance. But it's definitely a problem, and I don't think anyone has a perfect solution to it. But if you do, count me in.
I'll be calling you up going, hey, let's talk about this. And so that's where I guess the business information side of it ties in. So you've got that credit insurance, and then Bobby, what's going on that side of the house?
Yeah.
When we're looking at that fraud piece.
Yeah. So, you want to make sure you're working with somebody that is looking at businesses from a global perspective, and that the data that's being used is actually being sourced from multiple constituencies to validate whether or not this is a real entity or not from a business to business perspective. So, as a credit professional, if you're just relying on your own internal knowledge, your own internal credit information, you're going to be more susceptible to blind spots with fraud, right? So make sure, my recommendation is make sure you're working with somebody that is looking at the broader picture. Even if you're a U.S. company that only sells to domestic companies, you don't know who your customers are dealing with too, right? And and some of those could be international. So you want to go deeper to make sure that you're not stepping into something that potentially is fraudulent.
No, that's one of the things that we've kind of beat that drum on is, look beyond just, hey, this is our historical information, because everybody pays you till they don't.
Yep.
Yeah. And then it's like, he was the best guy ever. I'm like, till he wasn't.
Yeah.
Yeah. The number of stories of they were a best man in my wedding and now they owe me money, or,
I think
godfather.
Every credit person, everybody, in that whole, you guys probably have some awesome stories about it, but there's always that, oh my gosh, he's my brother from another mother. I'm like, please don't ever say that again, because that just goes out the window when somebody has any kind of financial situation in their life. It's like they want to be a good person, but stuff happens.
And the closer you are, the less likely you're going to know it early on. They're going to be hosing the people they don't like first, and then you're the last to know about it. So
okay, that's a good point. It's you're going to try to keep that you're not, or you have your blinders on. You're like, I don't want to see this in this customer because I really like them and they're really nice. We've had them a long time, and it's like, I don't want to have that hard conversation where it's, you're in the 90-day column and you're still taking stuff out. Can we talk about this? It's like, they just don't want to have that. So I think we're getting better as an industry. We're not there yet, but we're getting better.
And some of that actually allows us to step in and be the bad guy, because I look at credit black and white, yes and no, where credit professionals have to look at it as it's business. They're making a business decision, and there's relationships that are involved. And I tell everybody, I was like, let me be the bad guy. If I'm saying no, let me tell them no, because then you can back off and say, we can still go to the lake this weekend. But listen, Joe says you owe me money, so you better pay it.
It's like, look, can you afford gas? Because you haven't paid for your building materials. Maybe
Exactly.
we're gonna be on a paddle boat or something. But those are really good points. Credit requires you to have those hard conversations, and not everybody's cut out for them. Not everybody's comfortable. And even if you are comfortable with them, there's a lot of times your company leadership or ownership will come into play, and they're like, kind of dial it back. So I really do think there's an amazing place for credit insurance in that trade credit arena. My experiences notwithstanding, but I understand after having conversations with you guys that, a lot of that was self-inflicted wounds, and I was angry at the wrong person. We should have set it up better. And I like that you're able to learn from that and go, okay, let's make this better. What are the questions I need to ask going in? How does this work? What does the process look like? Give it to me laid out, show me in dollars. It's like, look, here's what your deductible is. Just like if I got an offender bender, I have a $500 deductible and we'll pay everything past that kind of a situation. So knowing that makes it so much easier. It can actually use it as a way to kind of cap your bad debt, because here's what the policy cost me. Here's what I could potentially lose. But if I balance the two against one another, I'm still coming out to the positive.
Yep. I tell everybody when I sit down with them, if this doesn't make financial sense, I'll be the first one to tell you that this isn't going to work out for us. Because if you're not seeing positive to your top and bottom line, then you're not going to be happy with it. Some of the easier math that you can use is everyone's going to have a bad debt reserve that's sitting there.
True.
Let's say it's $100,000. Well, that $100,000 is covering $100,000. You buy $100,000 worth of credit insurance, I'm now insuring $100 million of revenue. So the numbers just start to change when people start to look at it that way, or from a sales expansion standpoint. If I don't say no one time a month to a new customer, what does that actually equate to for our business? And that's where the product actually becomes entrenched in businesses, both from, like I said, the top and the bottom line, from the credit and the sales teams, to look at this as a way that they can run towards the goals of the business.
Now, see, to me, that makes total sense. And I think you just heard like several CFOs perk up on hearing that. I think what kind of trips people up is nobody thinks they're ever going to get hit. It's, well, we have 100,000 reserved for bad debt, but we haven't really written anything off in the last, 5 years. It's like, I get that. It's like gambling. You're playing the odds. Maybe you won't, maybe you will. With how things are right now, the only consistency is that there's no consistency. I mean, the credit manager's index comes out in 1 month, it's up, for DSO, the next month it's down. That same month it was down for collections, but up for collections the next. And so the data is all just contradicting itself. And there's no like consistent nice line like you've seen in past years. So that's always something that, kind of look at all of your options instead of don't rule out this particular tool because you're not familiar with it. And I made that mistake for years. And I'm a credit manager enough to admit it.
Well, I'm glad. I hope our conversation helped to spur that along a little bit.
It definitely did. So, Bobby and I had an amazing conversation. I'm like, we have to talk about this on the podcast. So when you see what's coming up for the next decade, any predictions, anything you're like, hey, you should be watching for this, or like, if I had a crystal ball, I'd be on a beach.
From my standpoint, if we're going to look at the next 10 years, let's go back 5 years. Who could have predicted the last 5 years?
Good point.
I mean, it's such a dynamic world that seems to have large scale changes. I mean, look at the tariffs. They come on one day, they're off the next day. You can't manage that. Like, that's just not something that businesses know how to manage. They're looking 6 to 18 months plus out into the future of what they can do. So The next 10 years, no idea. It's going to be a ride. Let's hope for smooth sailing, and let's hope the last 5 were calm.
Now, I guess we'll see. Bobby, you got anything you want to add to that?
Yeah, I would say, just from a business information credit assessment standpoint, I think you're going to see an accelerating trend to use non-traditional data to make decisions off of sentiment data.
Let's talk about non-traditional. So what do you got in mind there?
Yeah, well, non-traditional, I mean, it runs the gamut. I mean, our own company, for example, we have non-traditional data that we provide that nobody else has. So it's proprietary and non-traditional, specific to how somebody's insurance behavior has been over the last 5 years.
Okay.
That's an interesting aspect. But beyond that, you've got other data points that I think are, again, going to be an accelerating trend. Sentiment data, by that I mean, not credit references, but like facilitators of customer reviews, supply chain reviews. How does a business operate within its community, et cetera, et cetera? I think those are going to be some variables in the credit decision-making process that today are just kind of left on the cutting room floor. But there are companies that are already doing some of that. But I think we're going to see more of that over time, because that's going to be some of those soft indicators that, part of the 3 C's of credit kind of address that right now don't get tackled too often. Is somebody willing to pay? It's not, are they paying, or are they, can they pay, but are they willing to pay? I think with sentiment data, you're going to get a little bit more deep in that here in the next few years.
Interesting. That's a whole nother podcast we could be talking on.
Yeah.
All right, so we're kind of wrapping up. Is there anything that you absolutely need to know about credit insurance that we haven't talked about, that you're like, look, we missed this? I've got to get this in here.
The biggest thing is it's customized to everybody. So taking or hearing this podcast and making a decision might not be the best way to look at it. But having a conversation with somebody that's an expert in trade credit that can actually talk to your listeners about what their situations are is going to be the best way to make sure that this product is or is not a fit. At this point in time, our penetration is still very low from an industry standpoint. So our goal is to evangelize what this product is and how it works, because there's a lot of people that don't understand it. So the biggest thing that I ask everybody is, let's have the 30-minute conversation. Let's see if it makes sense. And if it does, we'll take it to a second date. If not, we're just going to move on.
No, I can tell you, my view of credit insurance was pretty low. I do realize it is a great tool. As I have matured and got to experience some other opportunities, you do realize that it's something that can come into play. A lot of it is just understanding it and knowing what your policy says and what you're trying to do with it. I really appreciate your time today. This is a topic that a lot of credit people don't get to explore and ask a lot of questions. If anybody has any questions out there that we didn't cover and you'd like to see revisited, guys, you know how to get a hold of me, Thea at creditoverlord.com, or send something over to the magazine. We'll get those answered for you. This wraps another episode of LBM Talks Credit with Thea Dudley, the Credit Overlord, and you can find us on Apple, Spotify, and YouTube any day of the week. For the past episodes, we come out every other Tuesday, and if you miss us and want to fill in that other Tuesday, you can catch Sally on LBM Talks social media on the in-betweens. Until then, we will see you next time. Thanks for joining me this week, your only place for practical strategies navigating trade credit in the LBM space.